Hello investors, welcome to Simpli Stocks. The famous GLP-1 drug Semaglutide, which is also known as famously weight loss drug, has now gone off patent in India. It went off patent just last week on 20th March, and in such a short time, more than 40 pharma companies have already applied for it. So it almost feels like a gold rush seen in the pharma sector. Now, you might be seeing it in the news too. It is trending a lot right now, especially in the investor community and even on Twitter. Now, let's say if the adoption of GLP-1 drugs really takes off in India, how can you benefit from it? For that, today we will study a fast growing, moated, near monopoly business that can be a direct beneficiary of the GLP-1 boom. This is a business we have been tracking for quite some time in our Simply Stocks community too, for our community members. And it is also part of an ACE Investors portfolio. My name is Vikalp Mishra and I am a SEBI registered research analyst. And today we will go through a business that will be a direct beneficiary of the GLP-1 boom, and we will also look at the GLP-1 as a trigger in detail. First, let us understand what semaglutide or GLP-1 drugs actually are and why there is so much hype around them in the market. So, in very simple terms, semaglutide is a GLP-1 class of drug that was originally developed for diabetes patients. It works in a way that after taking it, you will feel full, like your stomach is constantly full. You will not feel hungry for a long time. Initially, it was introduced for type 2 diabetes patients, but think about it, like if you are not feeling hungry, you will naturally want to eat less. And when your diet reduces, your weight loss journey becomes easier automatically. So basically, semaglutide helps in suppressing appetite. That's why even the people who struggled with weight loss started using it, and its off prescription usage increased a lot. So if you follow Bollywood, many celebrities have used GLP-1 drugs to lose weight quickly. And in the US also, the adoption of GLP-1 has been very rapid. Almost 10 to 15% of the adult population there has used GLP-1 drugs at some point of time. Now, what happens when a drug goes off patent is that its price drops significantly. Earlier, this drug used to cost around 8 to 10,000 rupees in India, but now after becoming generic, it is available at less than 3 to 4,000 rupees. And so far, the cheapest generic version has been launched by Natco Pharma, priced at around 1290 rupees per month or roughly 325 rupees per week. Now, obviously, when the price of a drug or anything drops this much, its demand goes up and the chances of mass adoption increase significantly. And India has always been a huge market for such products or any kind of product. So there are, I will tell you, let me share this data. So there are more than 10 crore diabetes patients in India and around 13 crore pre-diabetics. If you also include people who are overweight, or let us say those people who are having trouble losing their weight or getting leaner, so the total addressable market becomes very big, massive. And that is why so many pharma companies are now chasing this GLP-1 opportunity. Now, how can you benefit from this opportunity? So semaglutide is delivered through such pre-filled injection pens, which are also called drug delivery devices. And the business we are studying today operates exactly in this segment. It manufactures these drug delivery devices. The company's name is Shaily Engineering. It is a fundamentally strong small cap business. Shaily is a proxy player, meaning if semaglutide sees mass adoption in India and other countries where it has gone off patent, Shaily will be a direct beneficiary. Shaily is already adding back-to-back manufacturing capacity, and a lot of this capacity has already been booked by well-known pharma companies. And you will see here, Shaily is also part of Ashish Kacholia's portfolio. He holds around 3.22% stake here. Apart from this, over the last 1 year, FIIs have also been consistently increasing their stake in Shaily Engineering. You will see back in the June-September 2024 quarters, FII holding was around 2 to 3%, which has now increased to around 12%. Now, I know some of you may come to argue in comments that I am covering this business so late and it has already rallied. So it is nothing like that. I have been covering Shaily in our Simply Stocks community for a long time now. And even on YouTube channel, our YouTube channel, I have made references to Shaily a couple of times. So it is not like that we are covering it after it has rallied. So nothing like that. And just before moving forward, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simply Stocks, where we cover such businesses frequently so that you don't miss out on good businesses in the future, and you will keep getting timely updates whenever I cover any such business in the future. So now let's come back to our discussion. So currently Shaily has the capacity to manufacture around 4 crore injection pens per year, and in the next 2 to 3 months they are planning to double this capacity. So their total capacity will increase from 4 crore to 8 crore injection pens, and most importantly, this entire capacity is already booked. Apart from this, the company has already started working on additional capacity in UAE. Even there, around 50 to 60% of the capacity is already committed, even though that capacity, mind you, will come 2 years later. So you can see clearly that there is a huge demand for injection pens, but supply in the sector is still limited, which is prompting pharma companies to book capacity, or let's say to book orders in advance. And you might remember that we identified this similar trigger in our data center bet TD Power, where there is a backlog of orders for the next, say, 5-6 years. Now in India, their capacity will become 8 crore after this capex goes live, and they are setting another, which I told you, another 7.5 crore capacity in UAE, which is expected to go live in the next 2 years. So yes, due to the ongoing global crisis, we can say that the timelines might get delayed slightly, but overall for the next 2 to 3 years, I think they have more than enough capacity to meet the demand. The company estimates that its healthcare segment can comfortably grow at 30 to 40% CAGR over the next 4 to 5 years. Now, Shaily earlier used to make plastic products for consumer beauty and personal care segments, but in the last 1.5 years, it has been growing its healthcare business very fast. And these injection pens come under this very healthcare division only. Now, please listen to me very carefully and try to understand this properly, else you will miss the whole crux of this video. So what happens is that when a fast growing segment, which was initially small in size, becomes big, its contribution to total sales of the company obviously increases. But at the same time, the overall sales growth automatically becomes fast and it starts accelerating. For example, if you see here that in Q3 or the October to December months, Shaily's sales increased by 32% on a consolidated basis compared to the last year. They have different segments. You can see here, one is the consumer segment, then there is also the industrial segment, but the growth there is not very strong. The main thing to focus on here is the revenue from the healthcare division. That has become, mind you, 2.5x of the last year. In Q3, it showed 139% year-on-year growth. And if we look on a 9-month basis, it has grown by 158%. So the growth is huge. Now, the healthcare segment contributes around 40% to the overall business now. So obviously from here, as the healthcare division revenue grows, the current overall growth of around 30-35% will further accelerate. So this is a very, very important trigger in Shaily, that you need to look at the business directionally. Apart from this, another trigger is that the healthcare segment is a very high margin segment. Because of this, you can see that margin expansion will also happen in the company, and actually it is already happening. So that margin expansion is happening at a very fast pace. You can see here, gross profit margin has increased by 11% compared to the last year. Earlier, it used to be around 45 to 47%, which has now increased to 56 to 58%. Apart from this, EBITDA margin has also shown strong expansion. In Q3, EBITDA margin has grown by around 3% year-on-year. And again, if we look on 9-month basis, there has been a massive improvement of almost 7.5%. So all in all, as the healthcare division continues to grow from here, the company's growth rate will accelerate further. And because of margin expansion, you will see even better growth in the net profit or bottom line. And as I mentioned earlier, this is a fundamentally strong business. You can also see that its return ratios are very healthy. The company's ROCE is around 38.4%, and going forward, it can comfortably become 40-45% plus. Apart from this, Its debt to equity ratio is just 0.3. You will see the company is debt free, and fixed asset turnover is around 2x. So Shaily has all these nice triggers going forward. The company's growth rate can accelerate, plus the margin expansion, obviously. That is why if you look at it on the screener, the P ratio might appear high. But from here, you need to understand the direction of the business, that on a forward basis, 1 or 2 years down the line, and you have to value it accordingly. Many times what happens is people just look at the PE on screener and reject the business. They completely ignore what is happening at the fundamental level. So when you are studying growth businesses like Shaily, you should not make this mistake. You have to be open-minded when it comes to valuation, and you have to see why the market is giving it such a premium valuation. And it is not like Shaily trades at a premium valuation only because of its growth rate. The company also has a strong product moat. If we exclude China, there are hardly 4 to 5 companies globally that manufacture these kinds of injection pens. So Semaglutide, I'll show you, recently went off patent in China, and among the initial players who filed there, around 75% of them have partnerships with Shaily. So roughly speaking, Shaily's market share in Canada has crossed 50% plus. Similarly, if we look at the entire healthcare division, the company has already signed up around 23 to 24 major pharma companies. Then these pharma companies themselves have extended partners. So this means Shaily already has a good market share. Also, this is a business where a lot of regulatory approvals are required, and product quality matters a lot. So because of this, pharma companies don't change their suppliers easily. So there is also stickiness in the business. This is another reason why Shaily will likely continue to get a premium valuation because of all these factors. So the GLP-1 theme itself anyways will remain in trend for the next 1.5 to 2 years. So overall, we have a moated business in front of us with strong market share, growing fast. It is growing fast, and where margin expansion is also playing out. Along with that, the growth rate can accelerate further going forward. That is, I will say, sure shot. So this is a good business that you can study on your own. Now, the key risk to watch is regulatory risk, because it is a double-edged sword. If for any reason product quality is not up to the mark, it can lead to production delays or delays in commercial dispatches. Another risk is from China. So China has been known for producing low-cost alternatives. So if competition from China increases, it can lead to margin pressure for Shaily. So these are two risks that you need to keep in mind. Now, at the end, I hope you found this video informative and helpful. If yes, do make sure to like it. And if you support us with your likes and subscribes, we will be able to bring more such highly researched video for you every week. So I'll see you in the next video. Happy investing.